Welcome to PolicyCast, and today we will be covering a really massive update for the banking sector. After a long period of discussions and consultations, the RBI has come out with a draft of the new ECL framework. This reform is being seen as one of the most significant regulatory reforms over the last couple of decades and is set to redefine how banks measure provisioning and maintain capital. We have with us Jatin Kalra, leader of Grant Thornton Bharat's ECL modeling solution. Jatin has worked with more than 75 banks and NBFCs in India and globally on ECL over the last 8 years, including some of the largest banking groups in the US, Europe, and APAC region. Hi, Jatin. Good to have you join us for this important update.
Hi Simran, yes, glad to be here and have this discussion with you.
Getting right into this, let's start with understanding at a very high level on what the latest update is and why it has so much attention within the banking sector.
Sure. So, since forever, really, banks in India have created provisions based on RBI prescribed rates, right? So, there used to be standardized rates that a particular percentage is to be applied on the portfolio being carried by banks, and that is the amount of provision that you continue with. Risk-based differentiation was quite minimal. We only used to segregate standard assets and non-performing assets. And what that would mean is that if, for example, as a bank, I give today a loan to a AAA very highly rated customer, and at the same time I also give a loan to a sub-investment grade BB rated customer, both of them, even though they have different credit risk, significantly different credit risk, the existing regulations would end up requiring the same amount of provision for both of these loans. Now that of course was not great, and therefore ECL is now being proposed. It's a global standard, something which most of the other countries, especially the developed countries at least, have implemented over the last decade. And what it does is it focuses on creating that risk differentiation, wherein banks need to identify the credit quality of each customer, each segment, and create provisions based on that. So if you have high risk portfolio, you'll create higher provisions. Low risk portfolio, you'll create lower provision. Not only that, you also need to track any changes in the credit risk and increase or decrease provisions based on that change. If, for example, a customer has some deterioration in their financial health, and therefore the likelihood of default has now increased, and then I actually as a bank need to create additional provisions based on that. Furthermore, the ECL framework also requires the estimates to be forward-looking. In case, for example, in a particular portfolio or for a particular customer, we think that the future economic conditions are going to be tough. One needs to adjust provisions based on that as well. So example to understand that would be, let's say, I have agri portfolio, and in a particular state, monsoons were suboptimal, and therefore I anticipate that certain customers in that region would find it more difficult to repay the debt. Now, as soon as I am able to make that forecast, I'm able to create that scenario, I'll have to incorporate that possibility of higher risk and higher losses in my provisions, and therefore have higher provisions and keep that capital buffer in place for that scenario. So all of this, of course, would make provisions very risk sensitive. Each bank would create provisions based on their assessed possibility of credit losses, and that really helps in terms of resilience of banks, resilience of the entire financial system in that sense. So really big update, a big challenge for banks to really adjust to this new reality.
Thank you. So clearly, that's quite a significant change in more provisions will be calculated and what it would represent going forward. So when is it applicable and who all are covered in its scope?
So the draft RBI regulations are of course currently out. We are expecting that the RBI would look at the comments which it receives on that, and by the end of this financial year there will be a final regulation which would come out. The applicability is from 1st April 2027. So any reporting in financial year 27-28 is going to be incorporating the impact of ECL. Who are covered? All banks except small finance banks, cooperative banks, and regional rural banks are covered in the scope. So it includes all the public sector and private sector commercial banks and foreign banks. On all of these banks, essentially, ECL is going to be
Thank
applicable.
you for decoding that, Jatin. Grant Thornton Bharat recently published an in-depth analysis of the draft regulations, highlighting key requirements and complexities. While it's quite a comprehensive document, could you please share your top 5 takeaways from this analysis?
Top five takeaways. Okay, so the first one definitely was, a unique thing which RBI has done for ECL for banks in India, which was introducing certain floors. Essentially, what RBI said is, okay, go forward and create your ECL provisions, but then there's also this mandatory floors which are there, and your provision cannot be lower than that amount. And they've given this floor at, different product category levels. This is a very kind of, unique thing for banks in India because generally, if we talk about ECL in all other countries, they have not really had flows like these, or not at this level or to this extent for sure. The flows are of course creating unique scenario. Banks need to considering their portfolios whether the ECL is expected to be higher or lower than the flows. If ECL is actually going to be lower than the flows, then they may have to create more provisions than what would have been required under ECL. We're seeing that this is the case for certain kind of portfolios. There are certain low risk portfolios, like for example, certain banks have housing loans, gold loans, and all, which are relatively lower risk. But the flow would end up, creating a scenario where they have to carry significant provisions on these low risk portfolios also. We do anticipate that, there might be some feedback which banks would give to RBI on this, and it needs to be looked at on, what the final version of this regulation and therefore the flows which are suggested for ECL are going to be. Flows are also suggested at CCF and LGT level. There are different flows for stage 1 and stage 2. So a lot of complexity in terms of how you'll end up applying flows also. And, a good amount of analysis should be done by each individual bank to look at, how flows are going to impact them. The second one I would say is the whole thing around governance. We could see all through the draft regulation that RBI is very keen in terms of ensuring that there's a very strong governance on top of the ECL framework. They have directly, given the responsibility to the board and have said that there needs to be a subcommittee of the board itself that needs to oversee the whole ECL thing. The subcommittee would involve, of course, board members and also the CFO and CRO. Further, a lot of global best practices around model monitoring has also introduced. Things like validation, independent validation is now mandatory. You also need to do backtesting, monitoring test and all. Ensure that there's a model inventory, there's a life cycle which you maintain of models and all. So a lot of focus on governance, a lot of focus to ensure banks do it the right way. And it would require, banks to invest in proper resources and, invest their efforts to ensure that this happens appropriately. The third thing I would say is the whole thing around, making it forward-looking. Like I mentioned earlier, ECL is going to be based on not just historical loss rates and all, but also you have to consider what the future is going to be in terms of is the future going to be good or bad from a credit risk perspective, and adjust your provisions based on that. So in the draft regulations, they have specified how do you create scenarios, how do you justify them and all. And what we believe is that, banks would need to do effort, a lot of documentation, a lot of discussions to determine, what are the different portfolios or segments that they have from a credit risk perspective. And on each of them, how would they go forward and, predict the future essentially? What would be those variables, leading, indicators or economic factors which they would need to consider, which can really help them in terms of creating forward-looking ECL. That's number three. Number four is that they've restricted cherry picking of data. They've said that the historical data which you use should be used without any significant adjustments. So needs to be considered. And lastly, I would say, along with ECL, they've also brought in this requirement of effective interest rate calculation for income recognition. So while ECL is, the focus for everyone, one also needs to see how EIR would need to be implemented for interest income recognition and, invest appropriate amount of time for that activity. So these, I would say, would be the five, takeaways, like the very key takeaways from the draft regulations.
Thank you, Jatin, for sharing those valuable insights and helping us break down what this change truly means in practice. It's clear that the new ECL framework will require both strategic and operational preparedness from financial institutions.
No, absolutely. The regulations, signal a very critical move towards strengthening prudential norms from the RBI, forward-looking approach to credit loss assessment. It's quite an interesting development, and it would be interesting to follow how it unfolds and transforms into the final regulations now.
We'll be back next week with more conversations on tax, trade, and policy. Until then, thanks for listening to PolicyCast.